Hello, everyone, and welcome to the Quality Investing Podcast. In today's episode, I have Taiju Watanabe here for our conversation. Taiju is the CFO of Genda Inc., which is a serial acquirer in the entertainment industry, quickly growing into a conglomerate based in Japan. Genda trades on the Tokyo Stock Exchange under ticker 9166. It currently sports a 209 billion yen market capitalization, which is about 1.3 billion US dollars. As you may already know, I publish episodes infrequently in an effort to ensure that the content that I share is of a high quality, and also because my full-time job is running the Asheville Capital portfolio on behalf of my clients. My hope is that with each episode, you learn something more about a particular business that is doing something that is incredibly unique within the public equity universe. As the podcast name implies, I'm a self-avowed quality investor looking for companies that can compound intrinsic value per share at high rates of return for long periods of time. Therefore, it is super important to focus on the qualitative factors that drive future quantitative outperformance. This usually means that I gravitate towards businesses with traditional competitive advantages with large reinvestment runways behind those competitive advantages, because it makes it highly likely that the company's return on incremental capital is high going forward. Look no further than our recent episodes on InPost or Raxul for perfect examples of this. Today's business departs from that mold a little bit. While Genda's reinvestment opportunity is large and profitable, it is not, however, mostly organic. Genda is growing at a very high rate, primarily via mergers and acquisitions within the Japanese entertainment industry. There's an interesting dynamic in Japan with an aging population of small and medium-sized business owners who do not have an exit plan for their businesses. Genda steps into this dynamic in the entertainment industry, oftentimes as the only interested buyer, and receives a very cheap multiple in exchange for providing the business owner a tax-advantaged liquidity opportunity that would otherwise be unavailable to them. There are approximately 100 remaining independent operators in Japan, which control the lion's share of this highly fragmented industry. And Genda is the only business that is currently taking steps to consolidate it. These cheap but fair prices are allowing Genda to produce extraordinarily fast revenue growth, profitably, at a high rate of return, both now and hopefully into the future. Only time will tell. As a reminder, nothing discussed in today's episode is investment advice. I highly encourage you to do your own due diligence and to draw your own conclusions, or to outsource those decisions to an investment advisor, like Asheville Capital. Without further ado, please enjoy my discussion with Taiju Watanabe. I'm here with Taiju Watanabe, the CFO of Genda. Thank you so much for taking the time, Taiju.
It's a great honor. Thank you very much, Jake.
So I think it'd be helpful to begin the call just to hear a little bit more about your background. If you could introduce yourself, who you are, and what led you to this CFO role.
Perfect. Thank you very much. So I am the CFO of Genda, and I'm currently running the CFO role for 3.5 years. And prior to joining Genda, I was in Goldman Japan, investment banking, M&A banker. I was pretty much primarily doing healthcare M&As, and then switched to FIG team after becoming the VP. And then during the course of time, I spent some portion of my career doing some entertainment-related on IPOs and M&As, and that made me that had me have some grasp of what kind of business those are. That was my background prior to joining Genda. And then the Genda's president was coincidentally, the founder was from ex-Goldman, and it was a she, and she was and she and I met each other during the COVID era, and she introduced her company, and she was looking for a CFO for the role. And I was advising not only M&As, but also public offerings, including the IPOs. So I kind of had the grasp of what a CFO is required to do when it comes to like a IPO or public offering or debt offering or et cetera, et cetera. So I was kind of curious, and then had a chance to look at Genda's financial profile. And then it was after the Sega Entertainment acquisition. And then I saw the Sega Entertainment, by the way, is one of the largest amusement arcades in Japan at then, and it is now as well. And I thought amusement arcades was kind of what is the right term to say, but extinct, to be frankly. But my recognition was completely different. I mean, it was incorrect from the truth. So it was all thriving at the time. I would say it was like a real COVID era. So it was having a tackle, but still the cash flow was super strong enough to maintain the business. And then I found that amusement arcades was even thriving pre-COVID era. And probably if this goes through the COVID era, this could have another huge upside opportunities there. That was my first impression of Genda. And then I met with the chairman of Genda, who was ex the largest ex-president of the largest amusement arcade in Japan, and it is still the largest amusement arcade in Japan. But he quit his job at the prior to the foundation of Genda to found Genda together with the ex-Goldman president. And then I met with him, and he was talking about his vision to grow this entertainment company to the world's number one entertainment company by M&As. So M&A was what I can obviously participate in. And then these entertainment companies by ourselves do not own the cash ahead, but we can finance those deals deal by deal. And I saw the M&A terms to find out that this M&A was kind of unprecedented in terms of the valuation. And frankly speaking, it was low valuation. It was maybe partially because of the COVID era thing, but it wasn't. It was not necessarily the COVID related valuation, but also the intrinsic, I would say substantial reason there was. I'm gonna maybe touch upon later for those low entry multiple deals to be justified. Like it's a rational thing for the seller to sell those companies at a price that is quite unprecedented as an M&A investment. And we can finance by debt 1%. That was my like two upsides. Like amusement arcades was actually thriving, and it is right now achieving the highest earnings ever since the 40 years of operation today. And it's kind of surprising. That's one. And number two was that the M&As makes tons of sense compared to opening new stores or just the organic growth thing. And we can finance by debt, making the initial investment from the shareholders, which is myself as well. Employees hold, like top management to employees holds to 26% of the total shares, including the fully diluted basis. So we are going to be like the investors for this M&As going forward is an opportunity. That's what I thought. And then switched my career to join Genda. And we did the IPO last July, so it's been 1.5 years. And the great thing is that we were able to increase the share price triple at this time. Yeah, that was my story prior to Genda and the introduction of myself.
Sure. No, I mean, that sounds great. You've predicted and talked a little bit about a few of the questions that I already had.
Yeah, sorry.
No, it's okay. It's great. So you've already told everybody what the business is. It's arcade centers, basically.
Yes.
Could you describe what that looks like? I personally haven't been in an amusement center in a long time in the United States, and I imagine it's very different in Japan. Could you just walk through that?
Of course. So it is, I would say, counterintuitive for everyone to know that amusement arcades are recording the top highest earnings ever today. And the reason is basically it's based on Japanese anime boom. I wouldn't say it's just a one-off boom, but it's a gradual, stable, thick thing going forward too. Like it is fair to say that Japanese animation are catching a lot more attention than ever, not only in Japan but globally. And I would assume that that's something that's palpable in the United States as well at this time. And based on that, amusement arcades it used to be like a real video game center. So video games was composing a lot of the sales. It used to be, and that's kind of like a straight to your image maybe, or maybe in the United States it's slightly different, like more to the pinball or more like a physical game, like a hockey, air hockey things. And in Japan, it was more like a video game. And video game used to be super expensive. I mean, I'm talking about 1970s or 80s. So I'm not super familiar with those era, but I'm just reading the textbooks. So so it was fair to say that those video games, it was worthwhile coming to the amusement center to do that and split the cost of those video games by everyone with using 100 yen per each, rather than buying one hard thing in their houses. But in the course of times, it totally the game was totally changed, where you have iPhones, smartphone games, you have PlayStation 5, you have eSport, whatever you have is could be video games could be much more fun, much more catching attention in the houses, and they can connect to each other globally using the internet. They don't have to come to amusement arcade to be connected to somebody, which was a norm in the old days, but right now it's completely different. So as a result, video games only compose of less than 10% of the total sales. It's maybe surprising, but it's less than 10% of the total sales of amusement arcade. Where claw crane game machine, the prize game machine, or you can say UFO catcher in Japan, like
The
you have
the
the image of
claw
claw crane machine.
machines.
Yes, where
Okay.
you use the claw crane to catch a plushy
Yeah.
figure inside the machine is that thing composed of like 60 to 70% of the sales right now. So you can roughly say it's amusement arcade as like a claw crane game machine center, not like a game center, but maybe claw crane game machine center at this moment. And the reason why is that because claw crane game machine was there for I would say 30 years, 20, 30 years, but right now it's boosting. It used to be less than half, obviously, or it was like one part of the total sales, but right now it composes 70%. And the reason is the anime boom again. So what's inside is attractive right now, like plushies, figures of a certain animation. The customers or the fans want to catch those things, and it used to be just the fun of prize game machines are just to catch things. So whatever inside is fine, whatever is okay, and they can just enjoy whether they can catch or not. That was the fun of the prize game machine. But right
Mhm.
now, it's a combination of that fun plus what's inside. So what's inside is like let's say a huge anime plushies figures inside, where a lot of people have attachments too. And my question was that, like, hey, you can buy those at the stores. Why don't you go there just to buy like you can have a 100% chance that you can buy those things. But
Mhm.
here is, I wouldn't say this is like a super scientific background about this, but our hypothesis is that people enjoy the attachment to their like favorite IPs, like animes. So they are trying to catch those things a lot of times, and this experience is making some connection or affection or attachment to the IP plushies figures inside itself, which makes this like a boost in the prize game sales at this moment. And although the prize game boost, the total sales of amusement arcade industry is less than the peak right now. But the earnings wise, it's higher than it used to be, higher than the peak in 2006. The sales was highest in 2006, but earnings is highest in 2024 today. So this means that the prize game machines are much more earnings friendly, or I would say cash flow friendly, because the machine itself is not the key. Machine itself is cost like 10 times less than the real video game machine. Whereas what's inside is pretty much important. So what's inside, it's regularly there is a regulation in Japan restricts the upper limit of what's inside. So it is 1,000 yen. So I would say like like $7, $8. What's inside, you can place only $7, $8 what's inside. This means that you can place some like a iPhone or Nintendo Switch, like some expensive things inside, in order to limit the upper cost, which makes amusement arcade the cost is there. There's a ceiling. It's not like a cost rising up. What's inside is rising up. So there's a cost ceiling for what's inside, and the external prize game machine itself is not like a super high tech machine in the world. So combined together, the cost, like a supplier side cost, is like I would say limited compared to the demand or attachment or the willingness to spend to their faiths from the customers. So there's a supply demand gap for this, or I would say we are taking the arbitrage from those things. So what's inside used to be just online, but after the COVID era, people come to realize that they do not satisfy only with online, but they want some offline part of it. So we are thinking ourselves to be kind of like a Netflix, like a physical Netflix, where Netflix is the platform for online anime, whereas we are the offline platform for those animes. So that's
Okay.
what's happening in the amusement arcade world, and it's not like a real tech growth organically. Organically speaking, it's not a tech like a super high growth, but it's a stable, nice growth, and where all the costs are basically fixed. The very small part of it is variable cost, which is what's inside, and it's roughly speaking 30% of variable cost, whereas the 70% marginal income. So 1% of sales growth makes the marginal income 70%. 70% is just straight down coming down to the operating income and also the cash flow. So this gradual increase in the terms of the sales makes the cash flow generating power a lot greater and resulting in the highest earnings today.
Got it. So you're saying your costs are fixed on a per store basis, and so every incremental dollar of revenue drops almost straight to the bottom line in terms of free cash
Roughly
flow.
speaking, yes. Very very straightforward, yes. So I used to do the entertainment deal when I was in the investment banking side, and I thought there was much more fixed cost centric thing. So that was amusement park, certain amusement park, which maybe somebody can assume, but there's a certain amusement park that Goldman was one of the owners, and then where there was in Japan, and then it was more fixed cost centric. So the per capita spend, or like the number of attendees, or plus the per capita spending, if it goes up 1%, then yeah, the marginal income was great. I kind of think that's some similarity in this amusement arcade thing. So this is only organic part, yeah.
So the fixed cost model is really attractive when revenue is growing up because incremental
Exactly.
revenue drops to the bottom
And
line.
vice versa at the same
And
time.
vice versa. That's exactly right. So it can swing the other way.
Of course,
If revenue dips pretty significantly, you can drop into the red pretty quickly.
that is correct. Because
So
BOP is high, yeah, that is right.
yeah. So help me understand. You mentioned that there's a big trend going on in the rise of anime, and people want this experience of coming in store, of in your arcade, versus just buying it online via Amazon or via a regular retailer.
Right.
So what happens if the anime trends, and I'm not a person to be able to detect trends, especially in anime or what people younger than me are following, especially in another country like Japan. So what happens if that trend reverses, and what's the likelihood of something like that happening?
Okay, so as you mentioned, there's a high BEP, break-even point, because of the fixed cost-centric profile. So if the sales goes down, there's a chance that this could sharply go down. So that is theoretically right. And if the trend goes down, obviously that's going to be the result or the theoretic call a result. But I would say the mitigating factor would be that we are just in terms of the earnings, it's like a huge thick earnings, so it may slightly go down, but I wouldn't say it's going to like a right down to red. It's like a there's a deep buffer to that. Just to be like fairly speaking.
Okay.
With that said, so what's the likelihood? Is that we believe that's not very much likely to happen going forward, or at least for predictable period. And it's not like a surge, but it's like a gradual increase, like nice calm increase globally. So there's static data that can predict those things. So there's a data in 2023 in the United States where the where what kind of entertainment people like a questionnaire was what kind of entertainment people like. So the basic thought is like a baseball or football or ice hockey things, but
Hmm.
surprisingly anime was more greater than that in the United States. I'm talking about in Japan, it's obviously maybe it's a more cutting edge anime country, so it goes without saying, but in the United States that was happening. And even if you slice down only the questionnaire only to the like Gen Z people, then this was more distinct that people love anime greater than the like three largest sports in the United States, which is a surprising part of, and it's like a static data. So I wouldn't say this is going to like a easily shrink in the long term wise. And also, if I can add to a more broader perspective of entertainment. So in 19th century, there was people were working almost 7 days a week, and then there comes industrial revolution where you can use a steam power. So steam power is taking the people's work a lot to a greater extent. People start to work less or maybe 6 days a week. And right now it's 5 days a week. And there comes artificial intelligence. And in Japan, there's companies like do only 4 days a week style company, which is one of the largest companies. And then I would say people start to work less. And it's kind of intuitive to me that all the like a chores or like some part of it can be replaced by a new technology. And then what people do is they don't just end up working harder to for the holidays. They want to spend to their faves. It's what's happening, I think. And also the data says that they basically use those or their cash to their faves. I mean entertainment. So entertainment as a whole is gradually is like a long term wise. It's not like a shrinking, or I would say it's a um, totally the opposite in the global. I mean, in the long term wise. So with that said, so what kind of entertainment they're spending right now? It's Japanese anime is thriving. It's the data every single data I think you can find says the Japanese anime is not shrinking or is not like shrinking in like the foreseeable future. Is basically we stay optimistic about that trends.
Okay. What sort of margins do you earn on a per store basis for these arcades?
Sure. So these arcades, I wouldn't want to dive too much into those like organic thing because Genda, if you want to think Genda as like a potential investment target, I think 80% of the fruit will come from M&A and 20% from the organic growth. But organic growth, it is very important to be to check out how they're doing, but it's the in summary it is fair to say that you if you can confirm that it's growing to a certain extent, then it's perfectly fine because we are entering those M&A with a lot of alpha there in terms of investment wise. But with that said, those margins are basically EBITDA margin is 15% thing. So it's not like a
Okay.
best business in the world, I would say, but it's
Sure.
still nice growth. And if you only think about the organic thing, then those margins are very important. And those are the key competitive edge that you have to compete with the competitors. But we are saying we're one of the nicest amusement arcades in the world. In the scale wise, we're trying to become the world's number one quickly in the amusement arcade. And also, we have a lot of karaoke companies too. I would say 80% of the EBITDA comes from amusement arcade, whereas 20% from karaoke is our business right now.
Okay.
So those margins are, I'd say, in an absolute number basis, it's not like a highest business in the world. But the thing is that how much cash did you spend to get those cash flow is our M&A story.
Okay. So let's transition to talking more about the M&A story. So you
Thank you.
mentioned early on, you mentioned that you're able to buy these businesses at very attractive prices.
Yeah.
And that there's a rational
Yes.
reason as to why it makes sense for them. So you're not necessarily taking advantage. I guess what you're implying there is you're not necessarily taking advantage of the sellers.
Exactly.
You're giving them a fair market rate,
Exactly.
basically, on what they
I'm
can
just
earn.
saying.
So can you just go on? Go on. I'll let you take it away from there.
Yeah. Exactly. Yeah, you're right, Jake, that we're not ripping off people. If we are, then meaning that this is not going to be a sustainable thing. I want to mention that this is sustainable because the seller has a good rationale to sell those company at the price that we are buying. And so stepping back a little bit, M&A generally speaking, and people always come to say that, hey, in terms of M&A, the post-merger integration or like a growth after the acquisition is the key. So I think it's intuitive or fair to say that thing. But this is based on assumption that you have to, if in case of M&A, you basically have to pay premium to the fair value of the asset because the
Mm-hmm.
seller wouldn't sell if the fair with the fair value, I would say, or they will end up selling at the premium valuation because if they can stick to the asset for a longer time, they can have the cash flow. Let's say there's a company making 1 million free cash flow each year, and somebody comes to say, hey, I want to buy, let's say 5 million EV, and that's a free cash flow multiple, 5 times is like a EV to EBITDA, I don't know, 2 to 3 times, is
Mm-hmm.
not a deal because, oh, hey, I wouldn't sell those companies that the price. So they might stick to like 10 years, 15 years, 20 years free cash flow level, and they can finally think, okay, that's a good that we can start the discussion. And then if you buy those assets with 20 years free cash flow, your investment is in terms of listed company basis cost of capital.
Mm-hmm.
It doesn't make sense to recoup the cash within 20 years. It's not a prudent investment.
It's
So
not what your investors would be happy in, and so you'd have
exactly,
to find a way to increase the earnings
exactly,
rapidly in order to decrease your payback rate.
exactly. So that's the basic norm of M&A. So behind the assumption, there's an assumption that company has going concern, meaning that they wouldn't sell at a price that's discount or fair value. They have to because they can hold the company if they try to. Is the basic assumption. But in Japan, what's happening is that hey, so you can fairly say that there's a aging popularity in Japan. We are, I think, the cutting edge, or in the history of the human race, it's like one of the cutting edge um, aging population in the world. And also, that's still the world's number third GDP country. Combined together, it could be an unprecedented situation for M&A selling pressure. And I think that's why a lot of private equity funds, activist funds are having taking those such opportunities in Japan. I think, and the government is starting to open the market. They even said that unsolicited offer is welcome. It's what they say from the government is an completely different situation 10 years ago. So I think it started to finally becoming like a real capitalism style market, like a normal, I would say, style market, But meaning that there's a huge selling pressure from I would say the aged owners of those assets. So those assets are good. They have track records. It's not like a new product. It's just a amusement arcade or karaoke or other stable entertainment companies that has a huge track record. Something has 70 years of track record. That the oldest company we acquired recently was 70 years company. So we can fairly assume the free cash flow going forward for the business. It's not like a gambling. And then they, as I would say, like let's say 70 years old owners would think that if they pass away, let's say 90 years old, the average, like roughly
Sure.
speaking, the average life. If they pass away, they have to face the inherit tax of 50% in Japan. This, extremely speaking, it could be 55%, but in Japan, there's an inherit tax that they have to pay tax for those assets they inherit. So let's
There's
say,
a, I'm sorry, let me just make sure I heard you correctly. There's a 50% inheritance tax.
exactly, inheritance tax. That's right.
Okay.
So
Okay. So if I pass it down to my son after I die, he's taxed on 50% of that.
yes,
Of the
so
of the value of the business. Who determines that value?
if in case if that person passes away, that's the court is going to do the valuation, and the court is basically price to book based valuation, which is one time price to book one time. So if you have the positive net assets, then the net assets itself is going to be basically the valuation
Okay.
for the
Got it.
taxation. And it's another thing that's widely wrong from the valuation standpoint, because if this company is not making free cash flow but still has plus surplus net asset, then
Yep.
the son is going to have to pay the cash that they don't have. That's another part, but they have to face 50%. So if they held an asset with 1 million free cash flow per year, they can achieve 20 million free cash flow at the end of the day, but they have to pay 10 million, just roughly speaking, at the end of the day. So roughly speaking, selling the company 10 million or 10 years of free cash flow at 70 years old, without talking about present value basis, it roughly speaking the same outcome they can have. Or if they sell the asset, it's going to be 20% taxation. So roughly speaking, it's 12 years of free cash flow is equal to holding the asset forever. But is it really the same? No, from two perspectives. One is present value, so it's less than 12 years, 10 maybe 10 years, 8 years thing. And also, there's a because we're the cutting edge age population in the world, there's a term saying health year, kenko in Japanese terms, but meaning that whether they can have a healthy life, how old they can have a healthy life. Because at the end of the very last day, you're probably on the bed. So thinking about going backwards, you're 70 years old, still standing, maybe can enjoy traveling around the world is possible, but maybe not later years.
Yeah, getting cash flows earlier by selling to you, they are able to enjoy the cash earlier, obviously time value money perspective,
Exactly.
and
Exactly.
enjoy their 70s and 80s perhaps more than they would if they were continuing to operate their amusement arcade.
Absolutely right. So
Okay.
that's the key. That's one thing that makes their rationale to sell those company at the price that we're achieving. And also, if they have cash in the company, and if they hold the company with like personally, without any cooperation between those people, if they have the individual ownership in the company, if they withdraw the cash from the company, it's going also to be taxed like 55%. It's considered as an income tax. So, I mean, 55% is the highest income tax rate, plus the social tax included, combined together. Assuming that's a huge number. If it's more than, let's say, 0.3 million dollars cash withdrawal, then it's going to be taxed like 55%. So they are trying not to like withdraw the cash instantly, or they have struggle. They have certain struggle to withdraw the cash. But if they sell to us, suddenly they can have 80% of the cash, suddenly only tax 20%. So we buy the
Uh,
EV, we buy like a fair value. I would say in terms of M&A, it's a very good valuation EV plus the cash.
mhm.
We obviously just plus the cash. Then they are probably in the most cases very net cash position without almost zero debt. So we just pay the cash, but they can have 80% of the cash suddenly. And the ones crying is just the burden is only to the country, meaning the tax is going to be
Yeah.
country is going to suffer from this. But I think the taxation system is just implying that you have to let go of your asset before you actually pass away.
Okay. Got it. Got it. What prices are you achieving buying these businesses?
Um, so we even did zero point 0.1 times EV to EBITDA deal. We even do zero point 0.5 times. I wouldn't say it's 5 times or time. I don't know, but it's then 1 time, 2 times, 3 times. And right now it's becoming like a 4 times, 5 times range. But it's still like a perfectly in the money position, I think, because in terms of M&A investment, we might do 6 times. So we have almost never seen like 7 times or more because we just walk away and just wait for them to come back to us. Is basic our attitude.
What is that multiple on a cash flow perspective?
Basically, EV to free cash flow is like 50%. So if you double the cash multiple, like let's say five
Okay.
times is going to give you 10 times. And
Sure.
the thing is that these multiple is based on their actual number, meaning that we are going to improve this even improve a lot more after our acquisition because of the roll-up M&A, like a
Okay.
generic roll-up M&A thing. So we are 330 amusement arcade shops we have, and then if we
Mhm.
buy the five shops, they can suddenly have access to like a 335 shops, procurement power, bargaining power, or anything. So we do the cleaning together, we do the maintenance together, we purchase all the
Mhm.
figures plushies together, we purchase all the machines together. Those kind of like I would say easy to do raw up M&A style synergies. Plus,
You can reduce your cost of goods sold, you can reduce your operating expenses, you can reduce your maintenance capital expenditures.
exactly.
Okay.
So all the cost things, and also at the same time we can increase the sales. This is the great part in terms of the amusement arcade M&A, which is that they can suddenly have access to the best-selling plushies figures in their five shops. So if you only have five shops in the let's say suburban area in Japan, you cannot place the best-selling plushies figures in Japan. It's kind of easy to imagine, but because we are 330 shops and we are supplying the best top-selling IPs, and also Gigo exclusive, as Gigo is our brand of amusement arcade, but our exclusive plushies figures. They can suddenly have access to their exclusive prestige figures inside their five shops that they were not able to, obviously. And there's a lot of cases that they don't even have prize game machines, first of all, because they were, I would say, pop mom companies still doing video game centric style. And they were able to manage their company because the cash flow is basically like a cash is coming ahead. So the working capital is very small. So therefore, if the company is not thriving, they can still like continue to be alive, but still not have enough capex to even purchase a prize game machine. So what we do is like we just place our prize game machines inside our warehouse, and then place what's cutting the prizes figures inside it. Is making the sales grow and the costs go down. And obviously, there's a fixed cost centric profile, and this could have a huge impact in terms of improving their cash flow. And in reality, let's say this is a data that we have disclosed, but for the three, like I mean, it was a kind of long back ago we disclosed, but there's a three amusement arcades that we acquired after Sega acquisition. So we calculated how much time we spent to recoup the cash from the investment. It was less than 1.5 years. So the free cash flow multiple is like let's say 1.5 or 2 years, and
Mhm.
this is only for this is the total. Like we almost finance all these deals LTV 100% basis, meaning a fully debt finance, because this intrinsically very cheap, like a low valuation. So
Yeah.
we inject very small portion of our equity, and from the equity return wise, it's much greater than that. And I would say it's the equity return on our investment, because we only inject very small portion of it, like LTV 90%, 80% thing. So
Mhm.
the return is basically the IRR is roughly 100% ish investment for each deal. So
Yeah.
listed company 100% equity IRR is something I thought when I first saw Genda back in 3.5 years ago.
Okay. So if you pay it 5 times EBITDA, which you said is one of the higher multiples that you've paid, and it's 50% cash conversion, so you're paying 10 times free
Yeah,
cash for that.
roughly speaking,
And
yes.
you're financing at least a portion of that with debt at
Mm-hmm.
1%,
Mm-hmm.
but you're generating a 10% earnings yield on that.
Yeah.
Based on the previous historical financials, but you're able to bring down costs and increase revenues. So maybe instead of your payback being 10 years, maybe it's 5 to 7 years, something like
Yeah, and as I mentioned, the first three companies we did was payback was 1.5 years. It was
that.
a
Right.
COVID era thing, so it's a exceptional thing, but yeah, it's we can reduce the payback period.
Right. So I see how you can generate a return there, in the high teens to low 20% range,
Exactly,
sort of
exactly.
in a cash on cash return there, especially if you're financing it with 1% debt.
Yes.
But the question I have for you is, going forward, how do you continue to source attractively priced deals? Because it sounds like every private equity business in the world should be on top of this.
Right. So I have yeah, I had the same question myself too, and I asked myself again and again to come to this conclusion. So which is that so I think it's what we are trying to do. What we are doing is taking advantage of the selling pressure. So but there's very small number of buyers underneath. I mean, compared to that, which is almost only us. Why is my question? But
Mm-hmm.
I think we can justify this situation by from this angle. So if you think about the private equity fund, they have to sell at the end of the day. So who is going to buy this asset is the key, or the exit multiple. If they can increase exit multiple, is increase. I think I would say it's not an easy thing to increase the multiple. So the thing is to increase the intrinsic value of the company, or I would say the free cash flow of the company. But in terms of amusement arcade, you have to at the same time pay some capex, maintenance capex every year in order to make the uh, sales growth zero, maintenance
Mm-hmm.
capex. So in order to justify the 20%, 25% IRR, and without being able to fully finance the debt, I would say because we have other businesses, other cash flows, so we do not do LBO, we just do corporate loan, LTV 100%. But if it's a non-recourse thing only for the amusement arcade investment, I wouldn't think that the banks are willing to do 100% LTV. So they have to inject some of their portion, and they have to improve those assets without using any other amusement arcades. Is something if that's us, it's even harder for us too. I think, in order to justify the 25% thing. Compared to that, I think yeah, our approach is we don't lock in the cash for 10 years. So our cost of capital is much less than that. And yeah, all the reason I have said justifies us being almost the only buyer. And
Okay.
maybe you have a question for the strategic buyer, other strategic buyer. Why don't other strategic buyers wouldn't do this. This is, I would say, something. But let's say in Goldman, there's not much like a real entertainment banker because not much of entertainment companies in Japan do M&As actively, or I would say very, very, very low um, chances that there's one. I mean, this entertainment company, they are typically ones who want to do organic growth or cherish their IPs, or it's not like an inorganic, financial savvy people industry. So
Okay.
we are taking the gap between those strategies, or I would say those other entertainment companies, is just too large. And then amusement arcade wise, because we are still very small, we can justify $1 billion, sorry, 1 billion Japanese yen deal, which is like a 10 million US dollar deal, is okay
Mm-hmm.
for us because it still makes tons of sense cash on cash basis for us. But for them, maybe not. Is the key for us being basically the only buyer for all the deals. I wouldn't say this we are the only buyer forever. I think somebody can sometimes come in, and but we are okay because there's so much selling pressure for all these assets. So we can
Mm-hmm.
maybe share those fruit together. But I would say it's not an easy deal for those reasons for others.
That anticipates my next question, which is how you expect to continue to generate attractive rates of return, even if there's not a surge of competition from private equity or from other operators,
Mhm.
given that you're going to continue to increase scale. You've done a phenomenal job of doing that in the last several years of increasing scale. It makes it that much harder for incremental growth. There's a company here in North America that's very widely respected called Constellation Software that
Yeah, of course.
that you may be
Mhm.
very well versed on it, but they have I I'm not as in the weeds as other people are, but I don't think I would be wrong in saying that they have struggled to source deals at their existing scale that moves the needle for them. Maybe they can find a few tuck-in deals, but it doesn't really affect revenue more than, a few basis points or 1% or something like that, which isn't highly accretive.
Understand. So I think your point is that, and I totally agree with you that if we becomes larger and larger, in order to, it will be fair to say that it's extremely hard in order to maintain the same growth trajectory,
That's right.
because yeah, and I think yeah, you mentioned Constellation. We were looking at Constellation very well, and that they, to our perception, they are buying those assets. Even they become larger, they buy small assets. They keep on buying small assets, so the growth as a whole is going to go down. Is
Mm-hmm.
what they are. And compared to that, we see Danaher as well. Danaher is more like as they grow larger, they acquire larger things. So they have to do they have to restructure. They did very well, of some assets they have. We basically want to keep on becoming larger, but at the same time, they are using the tax-free spin-off. They are using their, if the growth rate goes down, they have to look more about the organic growth of their portfolios. And if this portfolio is greater in terms of growth rate compared to this one, and they might want to cash and then cash out the low growing business, and they may do the tax-free spin-off and have the cash with like a deferral tax, and then spend the capex on the organic growth of the growing business, things like that. I think we have role models going forward for the maintaining a large organization. And
Mm-hmm.
with that said, maintaining the growth trajectory could be technically difficult, but at the same time, we see a lot of pipelines at the same time. At this moment, if you take a look at the Japanese listed companies, the price to earnings PE multiple, I wouldn't say it's very low. I would say it's fair, or slightly lower than what it should be, or like they could be that you can. you could say that that's a fair value or maybe a bit discount. But if you take a look at EV to EBITDA, it's a huge discount or a super bargain sale. And if you take a look at those numbers, I don't think usual listed like a company, those investors wouldn't look at those numbers. But because we buy the whole thing, so if I'm an investor, I wouldn't buy one share of those companies. But if we can buy the whole thing, it's a totally different story because we can suddenly have access to their cash on hand, and we can change the cash flow going forward. Then this is a key. So they have to have too much cash on hand, and they have too less debt on hand at the same time, making them net cash position. So the market cap sometimes are very close to their cash on hand, making the EV very low. And compared to the low EV, they have a rich free cash flow. They're not thriving, but they're not declining. They're stable free cash flow that banks are willing to bet on the levered basis. So we're taking advantage of those opportunities, and they have we. It's fair to say that there are a lot of companies there,
Okay.
and there are activists over there. There are other financial sponsors trying to take advantage of those opportunities, and the government is letting them do it in these days. So I think that we want to maintain this kind of trajectory going forward as well.
Okay. So I want you to frame the growth opportunity ahead of you, the total sort of addressable market. But one thing we haven't discussed yet is your existing scale. Can you just give us a sense for
of course,
existing scale, and that'll help us to put into perspective what future growth could be?
Okay. So at this moment, what we disclose is that on a run rate basis, our sales next year is going to be like 140 billion Japanese yen, which is like $1 billion US dollars,
Okay.
something like, I think, yeah. And then 18.5 billion Japanese yen EBITDA, which is like 15 million. No, sorry, 150 million US dollars. It's
Correct.
Something like that. And then we have a net income plus the goodwill amortization, which is like we disclose this because like a quasi IFRS basis net income. If we calculate this, it's going to be 7 billion Japanese yen, which is 50 million ish, 50 million US dollars ish on the running rate. But prior to that, like if we focus on EBITDA, we are 18.5, but we were 8. We were 8 prior to that. And also, I mean, the last fiscal year actual is 8 billion EBITDA. So, which is a phenomenal incremental EBITDA growth at this moment we are achieving. And also, there's the 18.5 billion is going to be the next fiscal year. So this fiscal year, our original earnings forecast was 13 billion. So it's going to be 8, 13, 18.5 is our growth trajectory at this moment.
Okay.
Like roughly 60% CAGR at this moment. And we want to keep maintaining this trajectory going forward too. And we think, we stay optimistic, or I would say we are aiming a bit more to the north at this moment, but it's because it's M&A. There's always the counterparty. If the owner just at the very last day decides not to sell, then this is not going to be happening. But at the same time, again, it's they don't live forever, and they don't have a going concern basis thing. So I think if you stay long-term growth, or if you can wait for the long-term growth, I think this is there's a huge opportunity to stay optimistic about our growth trajectory going forward too.
Okay. Can you talk a little bit about the addressable size of acquisition targets? I mean, how many of these businesses are out there that run amusement arcades or karaoke? And I know you want to expand into some additional sort of adjacent entertainment businesses, but if we can just focus on what you're currently in and then expand outside of there.
Mm-hmm. Of course. So let's if first we if we focus on amusement arcades. So there are more than 100 players inside this like domestic market here. The reason is that like in 1970s, after the World War II, Japan becoming the economic boost with baby booms, and then they start to have some money to spend for entertainment. Is the like a like a initial entertainment boost, like a 1970s, and then they because the cash flow wise, all the cash are basically hard cash upward from the sales side, where you can defer the like your spending. So the small working capital feature was maintained a lot, and a lot of companies to survive until today. But these companies are suffering. As I told you, the earnings are highest today, but this is only for the top 5 companies for amusement arcades. And the
Mm.
number of bankruptcy of amusement arcades is the highest at the same time. So this is pretty much happening all together, meaning that you have to have scale, you have to have size to do the prize game machines, and prize game is the key for this business at this moment. So we are looking at those more than 100 players in Japan, and at the same time, we also want to take a very close look at the top 5 companies, the top 10 companies at the same time, and because they are basically underneath. The top 5 companies are basically underneath some large corporation. Let's say we acquired Sega from
Mm.
Sega Group, 100%. Taito is 100% Square Enix. Bandai Namco is 100% Bandai Namco Holdings. And Round One is basically the only one like standalone listed, but they're not only like amusement arcades, they do karaoke, bowling, sport in the United States as well. So considering those features, we stay optimistic about our amusement arcade vertical raw M&A strategy. Is this
Okay.
is for yeah. And
Okay.
if I can continue the karaoke is more I would say sorry. So going back to the amusement arcade, the top 5 company only compose of the 50% of the total market share, roughly speaking. So the remaining 50% is composed of like 100 players over here. So I think this is a huge fragmented market in terms of amusement arcade. So there's a huge roll up opportunities. Whereas karaoke is more concentrated market, or like a normal market, where top 5 compose of 75% of the total market share. It's like a
Okay.
yeah, more like a typical market. So in terms of raw M&A opportunities, I think there's huge alpha in the amusement arcades, and also we can take advantage of the anime boom, the prize game machine scale leverage in the amusement arcade. So we stay more aggressive about the amusement arcade raw business. And with that said, there are a huge number of other entertainment fields over there. So what we see is that if we come across with a like let's say EV to EBITDA 10 times amusement arcade versus EV to EBITDA 2 times other businesses that we think the cash flow can stay the same for a future foreseeable future, then we stick to the low valuation company, because nobody will come to like KKR to say, oh hey, why did you buy this and that? This has no correlation together or whatever. So we think because each investment makes a lot of sense in terms of investment wise, then we stick to those like a investment thesis. So somebody can say that, hey, you're buying this for what reason? This doesn't have any this doesn't seem to have any correlation with those or synergies from the existing companies. But to us, oh, makes a ton of sense in terms of investments, is our feedback. So we indeed bought EV to EBITDA 1.7 times deal last May, or yeah, I think it was May, for the other F&B business. But still making a very rich free cash flow, and making tons of contribution in terms of cash flow wise today, with 1.7 times deal. But it seemed like a slightly far from amusement arcade karaoke. But we did this because it was investment wise justifiable. And with that said, there's a huge synergies in terms of the large entertainment. If you regard this as an entertainment, this is the same uh, what do you say, the stream of entertainment where there's IP and there's fans, and in between there's platforms. It's kind of like a large entertainment field. But we buy all the platforms today, amusement arcades, karaoke, to make the IPs come through to the people physically. But in between, there's a physical touch point. We have tons of physical touch points, so we place the F&B in all the karaoke stores today. I mean, we bought 385 shops karaoke, which is number third or fourth market share company, and then we place suddenly all the 385 shops for the F&B things that we already bought today. So this is some synergy that the F&B company by themselves can never do by themselves. But today they sit together. They sit together in the same meeting next to each other. So they can do whatever things that they have. I mean, there are numerous cross-sell synergies that may seem a bit like unreal from outsiders, but from inside, we think it's just numerous cross-sell synergies here. Yes. So this is the thinking about other entertainment fields.
Okay. Now, you recently purchased a company called NEN, N-E-N.
Yeah.
Correct?
Yes.
Which has a pretty sizable coverage in the United States. Pretty sizable business. It might be entirely based in the United States. I believe it has 8,000 locations per the press release.
Right.
Can you just talk a little bit about why this acquisition makes sense and why it makes sense to expand into the United States?
Of course. So to answer your first question, it was EV to EBITDA 3.7 times deal. I remember 3 times 6 or 3 times 7 times deal, EV to EBITDA wise. And the seller, there was some special situation for the seller to have the motivation to sell the company because of the reasons. There are 60 individual investors behind him for the chairman. So, and it was a 5-year, about 6 years ago investment pre-COVID era. So they wanted to kind of liquidate the original investment. That was one. And we financed all by debt. So LTV was 100% from Japanese bank. It was 1% loan. And obviously there's a currency risk here if we loan financed by Japanese yen. But still, because we can pay back those Japanese yen by our Japanese yen cash flow. So we're technically buying those assets without almost like a currency rate thing. And So that's investment-wise, it's fruitful, first of all. And then the second question, the opportunities in the United States, like growth opportunities. This is huge. Right now, we are thinking that this is going to be a huge expansion opportunities. So what we did for the what we do is just replacing our Japanese style or Japanese anime figures plushies in their 8,000 locations. By the way, we are already doing 400 locations in the United States, only for the small croquet game machine with Japanese animes inside. And maybe you can find one. Maybe it's under the brand of Kidulton, but it's still 400. And we're replacing the NENs 8,000 locations into our plushies figures and machines. And these same store sales growth was phenomenal after our test. So I think in the United States, there's a greater gap between the supply of anime versus the demand of anime in physical terms. Maybe there are some physical retailers from Japanese IP retailers that you can find in, let's say, Los Angeles, Little Tokyo, or in a like a population dense area. But in the suburban areas, I think if there's one, let's say one Pikachu in Texas or in the middle of the United States, it has higher popularity compared to if the Pikachu is in middle of Tokyo, meaning that there's a supply and demand gap here. We are not placing Pikachu, by the way, just to clarify, but
Okay.
we are supplying anime plushies figures for in the United States very largely. We're starting our expansion using the 8,000. We were doing organically using the 400 locations by ourselves. We were increasing the locations by ourselves rigorously, but we finally have come to be successful in acquiring the largest operator, NEN, the National Entertainment Network, with 8,000 locations all over the United States. We are switching our strategy to replacing the existing locations into our style. Is taking advantage of the supply and demand gap of anime in the United States.
That's interesting to hear that there's same store sales growth in the United States because, again, I'm a bad person to try to judge the trends of my peers, people my age group or younger, I guess. But I don't know of anybody that goes to arcades that here in the United States, and I imagine other investors might feel the same in the United States. Okay. So,
yeah,
can you just help me understand who it is that's going? Is it teenagers who are going to arcades?
So first of all, the operation we are doing is not like a real arcade. So if you think about our amusement arcade in the United States, it's more like a pinball, bowling, and some bar, and I think those combined together thing.
Yeah, that's what I envision. Yep.
Yeah. So we do only one or two things about that. We own one or two, but we're doing 400 or 8,000 is completely different from those style. So what we do is, if you think about the vending machine, it's the same business model as vending machine. So you place cloak-ring game, very small cloak-ring game machine, very cheap cloak-ring game machine in a vacant area of a shopping center, like let's say Walmart or something like that. And they are willing to let us do it because we split the revenue with them. So we do not pay rent, we do not pay labor, we do not pay much of a depreciation, the capex, but we at the same time split the revenue share style, which is like a totally same with vending machine. And if it's empty, becomes empty, somebody's going to come in, just refill and go back thing. Is what we do. That's how we increase the number of stores. And the main popularity that's doing is basically younger generation, like kids, teenagers. And it's not, I wouldn't say it's like boosting. It's a general nice like a cash that we are achieving. But compared to what's inside, there's a huge alpha here. So in NEN, the National Entertainment Network, it used to be I would say anonymous monsters or characters inside. So the fun was to just to catch the thing. So it was before 2014 in Japan. The way of thinking was the same in 2014 in Japan. But right now we see what's inside is the booth. So we take advantage of that feature. So making the only cloak-ring machine, only vending machine in the vacant area in the United States. Like you can see it maybe on the shopping center or like a cinema or whatever. Yeah, things like that.
Yeah. So you're increasing the attractiveness of the items in there.
Yes.
Things that people actually want rather than an anonymous toy.
Yeah, exactly.
Okay, got it. Regarding the balance sheet, so how do you think about managing your balance sheet going forward? Do you have about $26 billion in debt right now? You're guiding for $13 billion of EBITDA, $18 billion of EBITDA in the next 12 months.
Basis, yeah, that's right.
Run rate basis, which puts you at less than 2 times leverage. Roughly 2 times leverage based on this year's EBITDA of 13-ish billion. Do you anticipate this leverage to increase? And how do you plan on executing upon your large pipeline of potential acquisitions and making sure that you don't run yourself out of business?
Right. Thank you very much. So So our run rate is EBITDA 18.5 versus the debt you refer to was the actual debt number we maybe disclosed. But right now, because we have done so many acquisitions after that, and then some of
Yeah.
those closed after the second quarter release. So we're roughly speaking 50 billion debt, like a solid debt,
Okay.
gross debt level. So it's leverage is more to the north. But
Mm.
we got our debt capacity with using net debt to EBITDA because we have a very cash net cash position businesses. So banks are more keen on the net debt to EBITDA level, which makes a lot this discussion a lot less than the debt to EBITDA discussion. And our hurdle is roughly speaking 3.0x net debt to EBITDA is roughly speaking the what the banks are kind of willing or okay, comfortable to lever up. So technically, if we buy as the EV to EBITDA more than 3 times deal with using only debt, there sometime in the future there we hit the limit of 3 times. And if we buy
Yep.
cheaper than 3 times 3.0, then technically we do not never hit the limit with only using debt of the future. With that said, we do not want to go up to like 2.99%, or banks wouldn't let us do it. So I
Yep.
think there's a certain limit, 2 point, maybe late to, yeah, to 2 points sometimes. And at the same time, when it comes to it, there's an obvious concern for potential dilution. It's our way of thinking. I mean, it's fair to assume that okay, Genda is trying to hit the limit. It's kind of way of thinking. So we do not want to like the going up and up and up, and suddenly we press the button to do the offering, and up and up and up and do the offering. We do not want to do that kind of style. So in order to not to do that style, we so debt like only debt financing versus only equity financing. In between, there's a stock deal. You can use your stock as your consideration in terms of the M&A. So if we do those things put together with using debt, it's going to be more sustainable, smooth growth by maintaining the debt capacity. At the same time, using our stock this is technically incremental number of stocks, so technical dilution. But at the same time, if we use this our stock to a company that has less PE multiple than us, then technically this is EPS accretive deal. And our EPS being higher, typically higher than our acquisition, it's like a lot higher than our acquisition. So if we do full equity deal, full equity M&A deal for those companies, it's still accretive. And at the same time, we use debt. It's not maybe 100% LTV, maybe 80%, 70%, it could be 50%, 20%
Mhm.
LTV. It's still very accretive. So we want to maintain those sustainability going forward. And with that said, we did do an equity offering last July, 4 months ago, and we closed
Mhm.
that last July. And that was for the first initial follow-on offering after our listing in I mean 2023 July. We did IPO, and 2024 July we did the follow-on offering. And this follow-on offering was to finance the deals going forward, basically. So it's kind of like I would say not super friendly offering to investors. Me being the investors as well, I wouldn't want to do this deal too much, because it was whether the investor trusts Genda or not is the key for this offering. Whether Genda can
Mhm.
use this new equity insurance to increase the number of, I mean, the cash that they achieve is the thing. But we had a lot of justification factors to do this deal, because our share was historical high at the time last July, and also we had less and less number of liquidity in terms of our stock at that moment after the IPO, because we did a lot of M&As, and M&A story can only come fruitful to long-term investors, and long-term investors started to hold our stocks to a greater extent. In fact, Capital
Mhm.
Group has 6%. They publicly released that, and also other long-term investors and we see a long-term investors in our shareholder registry. So
Mm.
the liquidity went very low at the moment. So we did the equity financing to become a lot greater liquidity. I think it's justifiable enough for the U.S. investors to do a secondary entry for our company. That's true. And also banks, we did almost LTV 100% deal too many times. So banks are kind of saying, okay, you still have debt capacity, but why don't you show us your ability to finance by yourself? Is kind of like what they think, and I kind of agree with that. And we showed we proved ourselves to be do the finance, and also yeah, I think those kind of things combined together, we did a exceptional offering for this. But the ideal
Mm.
thing is that we do a large M&A and do a bridge loan, and then permanent basis we do some permanent loan plus some permanent equity, like a replacing the debt via equity is the ideal case, is what I think. But in between, there's a stock deal, stock compensation deal that we can do if we keep our stock price to a certain extent. It doesn't have to be a great extent because we buy these assets very cheap, but to a certain extent, and then it's fine.
Okay. Okay. So we've talked a little bit about the growth opportunities, and it seems like you're taking a pretty conservative approach to the balance sheet.
Mhm. Yeah. Mhm.
Yet there is an attractive pipeline of acquisitions ahead of you, and you're predicting some pretty high growth for your business without
Mhm.
revealing any numbers or anything like that beyond
Mhm.
just the next
Mhm.
12 months. But you do certainly anticipate it to continue growing
Right.
and hopefully make larger acquisitions rather than continue to do these tuck in deals. Just help me understand, what are the key risks to this business? What are the key things that, if you and me are having this conversation again 5 years from now
Mhm. Mhm.
and it hasn't worked out the way you hope
Mhm.
for it to work out, what are the top two or three things that you think might get in the way of that?
So yes, one is, first of all, is like another COVID thing. We're going to have a huge hit if that happens from a physical perspective. I mean, centric profile. So we are keep maintaining this business because there's rich free cash. I mean, rich cash flow. We spend capex, so it's not like a free cash flow wise very rich. We have a rich operating cash flow, but if this operating cash flow stops, I think there's going to be a huge trouble here. So we fear the COVID to the greatest. But as a counter argument, we still survived the COVID to a great extent in the Sega era. So I think we can just maybe 2 years of penalty box and then come back is the key. That's one. And also two, if we cannot do M&As, that's obviously one great risk that we face. So we believe at this moment, because we have done 34 deals since our incorporation 6 years ago, and we believe we still stay optimistic about this roll up M&A opportunities. We see
Mm.
good pipelines in front of us, et cetera, et cetera. But if this doesn't go through, the whole story is going to be a lot different from what I just said. And
Okay.
also, if we do a bad M&A, meaning that if we buy those assets very high price, at a very premium price, or if we fail to even maintain the cash flow of their standalone basis after our acquisition, could be another risk. Because we are based on the trust that Genda is doing M&A nicely, meaning that they buy cheap and then recoup the cash, meaning that there's not going to be a goodwill like a write-off thing.
Mm.
So those trust is, we if we lose those trusts, I think the story is going to change. But in order not to do a premium price acquisition, we always the reason is that I mean for those purpose, we do not disclose our midterm plan.
Sure.
Which if we disclose that in our internal midterm plan, then it's going to be a very aggressive one. and it could have positive action to the price, share price, but we wouldn't never do that because if we commit those numbers to the market, maybe at the end of a certain fiscal year, we might do a crazy deal in order to make that achieve
They'll
that
anchor
point.
on it. Yeah,
Yes.
you don't want sell side analysts to anchor on a growth target. That's only setting yourself up for failure. So
right. I saw a lot of cases in Japan for those things. So
I see it all over the world.
All over the world, okay. And
yeah, I see it all over the world. But
investment banks
that's a very good point. That's a very good point. So the chairman of Genda, I hope I pronounced this correctly, now Kataoka.
Perfect, yeah.
He recently tweeted out that Genda is building an entertainment conglomerate.
Yeah, Genda, right. Yeah.
Genda. That Genda is building an entertainment conglomerate. And that he aims to avoid Genda shares being valued based on a conglomerate discount, which is pretty common for conglomerates.
Right.
Where essentially a company's overall valuation is lower than the sum of its individual parts. And he wants to achieve a conglomerate premium instead. I know that you weren't the person that tweeted this out. That was instead your chairman. But I'd like to ask you a little bit about how you hope to achieve a conglomerate premium with the assumption that you're on the same page with him.
Great. Yeah. Yeah, I'm totally in the same page with him. And thank you very much for that question. I wanted to highlight those things during our session here. So let's split the discussion into two. So one is SOTP based, sum of the parts basis discussion, and one is an M&A growth discussion. So first, like in a typical situation where people say conglomerate discount, it's like they assume the company is growing based on the total organic growth of each portfolio. So they don't basically do a lot of large M&As to do a lot of to like lead the growth. But whereas the SOTP of each organic growth combined together is the basic the growth of the total company is the basic assumption. If we think about this, okay, maybe sum of the parts analysis, the total sum of the analysis parts is greater than the actual market cap of the company. It's kind of like a conglomerate discount thing happens. So in terms of there could be some discussion, the justification about that. But at the same time, what we see in terms of his tweet is that each entertainment company is basically, there are 5 points, like each entertainment company is basically valued lower than each company. The reason is that they have volatility for each company. So this entertainment company is good for the next 5 years, but maybe not for the next 5 to 10 years, maybe. And then another company B is growing phase. It's not maybe very good for the 5 years, but thriving after the 5 years, maybe. So there are some volatilities in terms of each entertainment company. But if you think about investing only one company, then your cost of capital is going to rise because you have to accept the volatility. But at the same time, to combine together, it's a nice cash flow generating machine combined together if we can offset those kind of volatilities together. And also, that's one. And also, number two is that each company, again, has too much cash on hand for each in order to cope with those volatilities. So we accumulate the cash on a CMS basis in the top Genda holdco company and allocate those cash to where the cash is needed or repay the debt as soon as it's not necessary. So those activity cannot be done by each company, making each company's EV the same. EV is basically the same. It doesn't reflect the corporate financial structure, but the equity value is going to different if the EV stays the same. But if we do the ideal leverage, then the equity value is going to change. Is our assumption. Is that number two? And also number three is the synergies. So somebody tend to say that, hey, you buy this and that, this doesn't have any synergies. But in fact, there is a huge synergies in a cross-sell, like an infinite cross-sell synergies happening in front of us, which is could be small as a whole, but cannot be done standalone basis, each by each. And this could increase the EV. This is EV, increase the EV at the same time. And number four is we disclose those things to external investors, including yourself, like outstanding investors all over the world, which
Hmm.
obviously these individual company can have never access to. So maybe some investors have uh, enough cash on hand, like with a low cost of capital, they can have access to those people, or they can have access to the banks that they can never have access to, things like that. And at the
Hmm.
same time, lastly, number five is the branding. So we want to we want to increase the fan of Genda. So if their company is have the Genda brand as a whole, they might have catch more attention, because this company, like a company A, can have collaboration with the company D that newly acquired, or something like that. Those kind of like a not mathematical, but the yeah, those kind of brand power. So with
Okay.
those five reasons, I think it's standalone basis versus combined together. In the entertainment field, there could be conglomerate premium, or at least to cope with the conglomerate discount thing. That's one. And number two is, with that said, we are entertainment company. We are M&A company for the entertainment companies. So our growth is basically justified, or is based on the M&A that we do. So we do not necessarily focus on our valuation cannot be justified based on each company's organic growth. Their PE
Hmm.
multiple is much lower than ours. So somebody come to say, hey, if you buy a lower PE multiple company, and this can say, in other words, they can say that if you buy a low growth rate, EPS growth rate company, then your total PE multiple could change. Is one discussion, but I think differently. Our PE multiple, or our EPS growth, is based on our acquisition, and we
Hmm.
acquire a company a lot more than the existing portfolio going forward. So our growth trajectory is kind of like a startup growth trajectory, where we increase the EBITDA 60% annually. It's not an amusement arcade. It's not a karaoke company that can do this, but as an entertainment M&A company, we can achieve those things. And this is again with huge debt. I mean, it's not huge, but uh, ample debt on hand, making the equity value a lot greater than they used to be.
Yeah. Yeah. Okay. Is there anything that we haven't discussed yet that you think is just important for investors to understand as they think
Yeah.
about
So
agenda?
I think still, I meet with a lot of financial institution professionals, and myself being a financial background, I haven't never met with a lot of people who really is in these kind of IP anime entertainment field thing. They to me it's I kind of understand it. I totally understand it. So let me rephrase this in a different from a different perspective. So there's again IP, like anime, growing anime, and there's fans. And in between, there's a physical platform like us. I mean, there can be online platform and physical platform behind us. It's kind of like a stayed back perspective of entertainment field. And
Okay.
let's say somebody recently told me an interesting story about, hey, Nvidia, the
Sure.
is thriving at this moment, but there's no reason why. That was he said. It was because everybody was all the capex or equity was on the software side. At the same time, right now, everybody come to realize that they need a physical aspect in order to make this happen for those industries. It's something
Mhm.
similar is maybe happening in the entertainment world, like IP versus the physical platform. So obviously, IP anime is thriving and they're catching attention. Everybody's into it, but at the same time, the physical platform is maybe under capex or making less attention. But if the IP grows to a greater extent, and it's a human being at the end of the users, so there should be a physical platform that is going to have catch attention. Is what that person said, and this made struck to me as a new angle to
Mhm.
vaguely catch the entertainment world dynamics.
Okay. Got it. Well, this has been a fantastic call. I've learned a
Thank you
lot,
very much.
and
Thank you.
n- thank you for taking the time.
I mean,
I think a lot of people are going to get a lot out of this, and I certainly have. So thank you.